So I think that that the Bitcoin ethos encourages the dissemination of, rationality in a lot of different ways. I think the big idea, the big opportunity, and this is something that the world really hasn't it doesn't have, or it hasn't had for a long time, is the idea that you could have perfected capital and get a return on it. So, for example, like, what's the end game? Say you end up with a bunch of Bitcoin. If you end up with 1,000 Bitcoin and it's worth 10 million a coin in fiat terms, right? Then you've got $10 billion, right, worth of something in fiat terms. Well, so I think we'll get to the point where the major banks will allow you to deposit the Bitcoin and they'll give you 500, 600, 700 basis points of yield against the Bitcoin. Like, I give you a billion, you're the bank, I give you a billion in capital, you loan it to someone that wants to borrow it or short it, they pay you 500 basis points, you give me 400 basis points. That's the role of a banker, right, in a conventional system. That's the way it's supposed to work, right? If it was gold, if I put a billion of gold into your bank and someone else wanted the gold and they paid to borrow it, you're facing both the borrower and the lender. You're putting your balance sheet at work, right? You're gonna guarantee their creditworthiness of the lender. I'm not gonna loan it directly to them because I don't want the counterparty risk, but if you're a trillion-dollar bank with a balance sheet, like a JP Morgan or Citi, I think I wouldn't have a problem giving you $1 billion worth of my capital, and I think that someone else would go to you and wanna borrow it, and now the $1 billion is generating 5%, so 50 million a year. So imagine I'm getting 50 million a year in income off of $1 billion, but I've also got it's in Bitcoin, it's not in dollars. So now when Bitcoin appreciates, my capital is appreciating while I generate yield. That's the holy grail. How do I actually, that that's the appeal of, like, I own a company that spits out a 5% dividend yield, and the principal is protected and appreciating. Well, if you think about just pure digital capital, why can't I just hold pure capital without corporate risk and get yield on it? And if that's the case, you've found a way to escape fiat inflation. Like, I mean, like, right now, I can get yield if I borrow in yen, or if I borrow in whatever, some other country. Like, I go to a country that pays high interest rates, like Turkish lira, and they'll give me huge interest rates, but the currency is collapsing against the dollar. So if you get paid 20% interest and then the currency is losing 30% of its value every year, your real return is minus 10% or something. It's not plus. So the problem right now is if I just hold $1 billion worth of dollars, I get 5% interest, but the currency is losing 7% of its value a year, right? So I've got a negative real yield on fiat capital. Yeah, the real fundamental problem is any of these institutions will generate billions of lots and lots of capital, whether it's Apple or whether it's El Salvador or whether it's Harvard University. They all have capital, but in order to get a yield and protect their principal against inflation, they can't invest in a liquid capital asset. They have to buy real estate. Probably real estate. You buy commercial real estate, and your inflation hedge is the underlying property, and then you get some rent, of which a lot of it you have to use to pay taxes and insurance and upkeep and depreciation, and then the remainder, might be some real yield, but it's not much. Generally, it's not a whole lot, and there's a lot of headache with it. And so otherwise, I own a corporation or a equity that pays dividends. So if I can own a corporation that can grow faster than the rate of inflation and grow cash flows faster than the rate of inflation, maybe in theory I can get there. But those are both very, very challenging. So I maybe in the mythical era of, in the golden age, if I had a bank I trusted in the golden age and my capital was in gold, then maybe I could deposit the capital in the bank and I could get paid interest, and the bank would then loan the capital and they would get paid and we would split the interest 50-50 or something. And that's a long-term strategy for, you know, preserving wealth and then paying expenses. But we lost that ability in the fiat age because it seems to me that, with probably only a few exceptions, the actual yield you can generate on fiat capital has always been a negative real yield. I mean, do you know of anywhere in the world where you can generate a positive real yield on fiat capital in a bank?
No, no way. Well, I mean, Lebanon before hyperinflation, you used to get 15% for your checking deposit, for your savings deposits. But look how that worked out.
You have to take some sort of corporate risk, technology risk, or investment risk, or real estate risk. And you have to tell yourself that the risk you're taking is less than the yield you're getting, right? Like, for example, they loan money to mid-sized companies. All these corporate lenders, they brag about getting 12%, 12 to 14% interest rates on secure loans. And so they're getting more than the 5% the government pays or the US pays. And so maybe they're getting an extra 8% and they're telling themselves that the risk that they're taking is less than that. But even so you get 12% on that loan, you're getting debased 8%. I don't think the monetary inflation rate right now has been, 7. I think it's been more like 9 or 10 for the past 4 years, right? So in this environment, you were suffering an 8 to 10% monetary debasement rate, and you're getting a 10 to 12 or 12 to 14% yield, and then you've got this risk that you're taking, and you're telling yourself it's not risky, but probably it is 4 to 6% risky. So at the end of the day, if you're taking 4 or 5% credit risk and you're getting paid 12% and the monetary debasement rate is 8%, then you've got a 0% real yield after adjusting for credit and inflation, right? It's kinda so you're those businesses, they kind of work for the general partner because the general partner is getting paid a fee off the top. But the limited partner that isn't getting paid that partici there if you're getting 2 and 20, of course, you wanna do anything. But if you're the limited partner, you're getting a nominal yield of, 8 or 10%, but after the risk, over 20, 30, 40 years, you're gonna have a blow up, which kind of wipes that all out. So we live in a world right now where it's difficult to live off of your accumulated capital without actually being in the business of taking risk. I guess that's what I'm getting at. And I think Bitcoin offers a different possibility. I see a world, we're not there yet, but I think 10 years out, I see a world where you would be able to take your Bitcoin, put it with a trustworthy bank, and the bank would lend it out, and they would give you a yield, and you could then never sell your Bitcoin, pay your living expenses with the yield the bank gave you, and then the Bitcoin would appreciate in fiat terms forever. And of course, for that to work, you have to have a trustworthy bank, right? What is a bank in that regard? I mean, classically, that's a bank that they take capital from depositors and they find creditworthy lenders and they charge an interest rate that covers the default rate. right? They actually do proper lending, and I guess this is, what's interesting here is that Bitcoin is capital owned by the people, and so the bank basically has to get a return for their own shareholders and a return for the capitalists that own the capital, and they have to cover the credit risk. And the existing fiat banking system is using bank owned by the public and by the governments, right? The government controls the capital that existing fiat banks lend out.